I will. Good evening, everybody, and welcome to the October version of the Mid-Michigan Manifest Investing Roundtable. My name is Ken Kavula. I'm a director with the Mid-Michigan chapter of Better Investing, and I'm joined this evening with my good friend Mark Robertson, who's the managing partner of Manifest Investing. I'm also joined with Cy Lynch from Atlanta, and also representing the Better Investing Board of Directors as chairperson, and Matt Spielman. Matt is a director with the Houston chapter and a former member of one of my investment clubs up here in mid-Michigan. It's real great to have the crew back together again. We hope in a little bit to be joined by Kim, but her schedule is always very fluid depending on how things are going with her caregiving right now. So without further ado, let's get the legal stuff out of the way. This is a demonstration. We're not making any recommendations to buy, sell, or hold any securities. If we own a stock that we talk about, we will make every effort to let you know how we hold it and give you an approximate idea of whether it's a major part of our portfolio or not. We are urging you to become part of our guest list so that we can send you reminders for this program. And more importantly, we can send reminders to your friends and family. If you'd like to get a reminder, send an email to nkavula1@comcast.net. And Natalie, that's my wife, will add you to our guest list. And if you have somebody else that you might like to add to the guest list, if you give them her email address, she can help them do that as well. If you like a copy of the slides, or if you have direct questions after tonight's program, a note to Mark R. at manifestinvesting.com, or a note to myself, kkavula1 at comcast.net. And we both answer lots and lots of email every week. We'd be happy to give a stab at yours, or get you copies of the slides if that's what you're looking for. So without further ado, Mark, let's go to our agenda. It's a pretty set standard agenda. We're going to present 4, perhaps 5 stocks this evening if Kim manages to make it with us. We'll have a little bit of discussion about the bear market, the bull market, and maybe some lessons that we're trying to garner from all of these different types of market. We'll look at our performance results. We'll take a real quick look at some stocks on the hot seat. We will do an audience poll at the very end, giving the audience a chance to add to the portfolio as well. So without further ado, how about we get started, Mark, and I'll turn it over to you.
All right, here's just a quick reminder. We have been doing this for 12 and a half years. Basically the same situation, Tuesday evenings, free webcast. You're encouraged to have your favorite beverage, adult beverage or otherwise, and you can attend in your jammies. The whole idea is for all of us that are contributors here this evening to identify an idea, a potentially actionable idea after study. We do talk about some non-core selections, which are basically companies which are very, in some cases, ugly or non-fitting on a stock selection guide. But we do encourage a little bit of playfulness, and early stage investing can fit into that, but certainly not an overpowering part of the portfolio. We are predominantly core long-term investors. Our goal is to beat the market by 5 percentage points. That's 500 basis points if you speak that language. We measure the market by the Wilshire 5000. And we would like to see the majority of our selections beating the market, but we're finding that even the best end up down around 50, so I'm not even so sure that we shouldn't revisit that at some point in the future. Here's a look at our long-term performance. What you are looking at here is the answer to the question, are you beating the market with the tracking portfolio? And if you are, by how much? And that's what's graphed here. You're basically looking at the answer to the question, how much are you beating the market by? Our goal is represented by that red dotted line across the middle. We'd like to beat it by 5 percentage points. What is relative return? Relative return is simply comparing the rate of return, that's an internal rate of return on the tracking portfolio. We basically invest $1,000 into every decision that we make, and then we keep track of every single one of those positions, compiling an internal rate of return that currently stands at that 14.4% number that you see there. Matching investments into the Wilshire 5000 are actually tracking at 9.1% over that same 12.5-year period. So the 14.4 minus the 9.1 is what gives you this number, beating the market by 5.3 percentage points. And so that's the number that's actually graphed right there. So that's the situation. As we said, about half of our picks have outperformed the market. As we discussed here a couple of months ago, we can actually show that our position in the gains in our position in Microsoft alone offsets all of the losses in the portfolio, which is just staggering if you think about it. And it's a topic I'm sure we'll come back and revisit. Anything else you want to add to that, Ken, or Si, or Matt?
Only that Microsoft might not prove to be quite as lucrative tomorrow when the market opens. I did see that they were down quite a bit in after hours trading today, so we'll take that all into account and report back to you a month from now.
Yeah.
If you could even see the change by that period. Remember, we're not following stocks on a day-to-day basis or even basically worrying too much about them on a month-to-month or year-to-year basis. We are long-term investors with a 4 to 5 to 6 year time horizon, and we don't panic very easily.
I think I agree with everything Ken just said. I just want to jump back to Mark and his comment about accuracy. And I kind of like that analogy or that example of Microsoft offsetting all of the losses, at least until today, perhaps. But because that visually or through example drives home what I always say: remember, the most you can lose in a stock is everything. And that may sound scary, but there is a floor. You can lose your total investment. And of course, and the reality is you usually don't. Stocks may be underperforming the market, but they don't go to zero. They, on the other hand, on the upside, theoretically, the upside is unlimited. And the longer you hold, the more, we get near that 13-year point for older holdings. And of course, the greater your potential gain. So you can a stock can only go down your investment, but you can, a winner like Microsoft or something, you may have 10 times your investment, which offsets the losses. That's why I like stressing the fact, don't get upset if half your stocks underperform the market, because you can, as this portfolio shows, meet your goals by being roughly a 500 baseball hitter, which would get you in the Hall of Fame. I had to get baseball in there somewhere.
Well, I don't very rarely move to sports analogies, but in this case, I always use the sports analogy. I use the idea of a home run throughout an entire investing career. If you hit 5 or 6 real home runs, and I mean, things like Microsoft, if you hit 5 or 6 of those during an entire investing career, that's usually enough to put you in the Hall of Fame and to keep you very comfortable if you followed all of the other kinds of things that we talk about, like investing regularly and focusing on high quality stocks at great prices. You do that, you hit 4 or 5 home runs during a career, and you got it made for the most part.
Sounds good. And I guess my only reminder about all of this is we're in a terrible market right now based on the average person in the street. I actually think it's a really good one. I think it's an accumulation zone opportunity, and there are actually some fat pitches out there right now. You won't know they're fat until a few years from now, but you got to own them in order to have a smile on your face 2, 3, or 5 years from now. So find
I
out.
will tell you, Mark, we're getting entries ready for our Mid-Michigan Stock Pickers contest. Those are due. They have to be postmarked by Halloween to count in the new contest for 2023. And this is the first year in a long time where it's been actually a lot of fun to put a portfolio together because I'm looking at par values in the double digits, in the high double digits, even in the low 20s. And I'm saying to myself, you know, that might be very reasonable 1 year from now. I'm a great believer that the market, you know, has ups and downs, but the general trend is to move in an upward direction. So my basis as an internal optimist says that this time next year I should be feeling much better about my portfolio than I am right now.
Well, I'm with you there. And here's actually, it's a nice segue by both of you to this. We mentioned Microsoft, and here's the way you read this chart. These are the 20 largest by percent of total assets or by total value of the companies that are in the tracking portfolio. Every time a knight or a guest damsel or the audience picks any one of these stocks, we put $1,000 into it. So you'll see up here under 5X, you see Microsoft. $5,000 invested into Microsoft is now $63,000. So again, that $58,000 gain offsets a whole lot of stumbles, a whole lot of them. So any one of those companies up there, and these again are the top 20 by total value. And as Ken was saying, there's a significant amount of green and a little yellow on the right-hand side there. So expectations are actually fairly high overall. Anything else jump here, Ken?
Well, the only one that jumps at me is that one that I still wonder why it's in the portfolio, but I defer to the speculator sitting in Rochester Hills, and I'll just skip over that ARDELYX stock and not worry too much about it.
Well, and Pasadena, because he's
and Pasadena. Okay.
Well, don't get me started. I mean, I picked it up at 57 cents a couple months ago, guys, and you all basically laughed.
And that's a wonderful, wonderful plus to the portfolio, Mark. When you can buy it at 57 cents, I'm not so sure I've ever had that happen, and I'm not so sure that I'm ever going to have that happen.
Well, it's sitting at least right now as the all-time best selection ever made. So let's hope it stays there. So I get to brag about it in February.
Okay.
So we take a look at the portfolio. I'm just going to jam through this really quickly. The average return on stocks, we actually put 2,500 stocks through the ringer every night and come up with the average return forecast at Manifest Investing. That stands at about 12.5%. So as we design portfolios and hunt for stocks, we'd basically like to, by design, find them in that 5 to 10% range known as a sweet spot above the average stock. So we're out there searching for stocks that are above average when it comes to their return forecast. So that's kind of our guiding principle. When it comes to the portfolio itself, we basically think the most important characteristics are the quality. That's excellent quality. That's the 88th percentile ranking on average. So we're basically looking at excellent companies overall in the portfolio, a weighted average. 16.9% for a projected annual return. Again, that's average. That's pretty good. It's beating the market. It's positioned to beat the market by 4.4%. We'd like to see it a little bit higher, but it's been actually pretty successful here over the last several months. So that's why it's down a little bit. And the third thing is we'd like to see approximately 11 or 12% growth for the average stock, and this is actually quite healthy. We could actually afford a really nice blue chip that's, we can actually afford a little bit of a drop in the overall growth rate. So if we find something that fits, that makes sense.
A good lesson that we've learned in the last 4 or 5 years, Mark, also is the difficulty in pushing your portfolio's par up to 5 points above a very elevated MyPAR number. We've noticed that as MyPAR moves up into the 12.5, 13, 13.5, 14% range, it becomes very difficult to keep the portfolio moving at 5 to 10 points ahead of that. I think it has something to do with the arithmetic involved, and you just you're lucky to stay 3 or 4 points ahead, and here we are over 4 points ahead of the average, and that's making me clap my hands with joy right now.
Absolutely. We want to keep it up, but like you said, it can be difficult. All right, the 5 stocks are here. They're on what we would typically call the hot seat. I'm going to call it lukewarm seat. Nothing there is approaching zero, even for the more core-like companies in the portfolio. So again, nothing is burning to be a sell consideration. Boston Beer has had actually a very nice rally to get us back to a loss of only 28%. But the rally has come in there, and maybe we could see some benefit or improvement in the fundamentals. But again, nothing here rings off the page. You are looking at approximately 2.5% of the total portfolio. So even if we dumped them all, it wouldn't make a major difference to the portfolio. And again, these companies here are basically trading in a pretty decent range. So I don't consider any of these to be on a hot seat. This is just a reminder of tonight's news as what's going on at Microsoft, our largest holding. I suspect they guided lower because this number shot up at the end of the day. They probably guided lower in their conference call after the market closed. Any other comments? Keep pressing on.
Press on.
All right, some of the other things that we like to look at, we're looking for companies which just are not behaving very well. The bottom table is from a month ago, and you can see there were many more of that company that Ken doesn't want to mention by name in that list, and some of them have mysteriously disappeared, Ken. The current one up at the top is the stocks which have basically not performed very well since we selected them. I mean, Candace and I and the audience probably made the best selection in the history of the roundtable back in April here with Generac. These 3 selections, I think, were probably the 3 best selections ever made. It's just not working out very well so far.
You were just way too early on it, Mark. That's all.
We were early. So I still think that there's a lot of promise for that one. And as you go down this list, I think we'd probably have to wrestle side to the ground to sell MKS Instruments, but they're just not behaving well lately. And of course, Ken's love affair with the Advanced Micro CEO, we can't sell that one. So, you know,
if I liked it at 87, Mark, imagine how I feel at 61 right now.
Exactly. Nobody out there should be recording this or writing any of this down.
I think a great lesson that we've learned, Mark, is that this rule of 5 that we've been fooling around with now for a good 6 or 7 years is much more effective during a bull market than it is during a bear market. The bear market just plays havoc, and the extra amount of volatility that goes into some of these stocks during this kind of market just plays havoc with a rule that says you must. And I think maybe Cy had some of that in mind when he kept warning us that this rule was going to be much more difficult to actually implement than it was to think up. So.
Yeah, and I remember Cy pushing back really hard on EPAM systems. I get that. He basically was saying, why don't we wait and see if this is a temporary problem? Do you want to expound on that or expand on that, Cy?
I was actually thinking of one word all the way through is patience.
Yeah.
But yes, EPAM is a prime example of and EPAM. I mean, you're talking about a war that both impacts a significant portion of your customer base and the majority of your employee base, and yet company was able to adapt very well and has not only well outperformed the market, has well outperformed its business expectations.
Mm-hmm.
Yeah, the company actually has been reporting they've been reporting excellent sales. They've had, or earnings have taken a bit of a dip because, again, they have incurred extra expenses in moving some of their Ukrainian employees to safer areas and trying to do more recruiting outside of Eastern Europe and that sort of thing. But I think EPAM is a wonderful example of that temporary versus permanent problem.
Yeah, and if there were one company here that I would think I would put under a microscope if it was my own portfolio, maybe Marine Max, just to make sure that there isn't something being missed there. But that's the only one on there that I would attack at this point.
Well, and there's one company, Mark, that stands out for me, both because I own it and because I've always had such respect for it. I'm certainly glad to see Adobe, which appeared on the September Rule of Five list, is gone from the October list,
Mm-hmm.
which tells me that it's been gaining on the market. Adobe came down to in my top 4 choices. I didn't choose it for this evening, but luckily our friend from Houston did choose it, so we're still going to hear about it tonight. I'm a great believer that Adobe has a lot to run, and it's at a very interesting price right now.
And again, not to beat too many dead horses, but I'll pile on Ken's comment attributed to me earlier on just a moment ago. There is a prime example of the volatility of both this rule generally and especially in the current market. Adobe, that was potentially a Rule of Five sale next month, has suddenly become a buy this month.
Mm-hmm.
Yeah, it's moved me from much more towards the center where I appear to be on almost all my politics and almost all my investing rules as well. So I don't know. Is that just wishy-washy? Is that all that is, Mark?
We're gonna move on. You got political on us.
Okay. All right.
Let me say the P word again: patience.
Patience and discipline, coupled with discipline.
Yes, and discipline matters.
Yep.
Absolutely.
All right. The other thing that we watch, and it actually provides that counterpoint that we were just reaching for with Generac. Again, this is almost an emotional short term, and that's the other point missing. This is short term stuff versus long term stuff, entry point and exit point type thinking. And in this case, we look for companies which are in the potentially oversold range, and that in this case, Generac, which we just mentioned, is probably oversold. And First Financial also, even though they've held up very well, they still have a very staunch return over time. They've both been punished, perhaps unduly. Then on the other end of the spectrum, down at the bottom, these are companies which are basically percolating pretty well. Up around 70, we typically get more serious about noticing this when it gets above 80. But these are companies, if somebody held a gun at us or pointed it in our general direction, these might be candidates for a sell consideration, but unlikely. All right, so let's go ahead and press on with tonight's stocks. Sai's going to lead us off with Littelfuse.
All right. This, I think, is the 7th month anniversary of the first selection of Littelfuse back in March when I brought it to the round table and added a share, and the audience joined in. I hope that Mark hasn't cursed us with doubling down today, but as I told him, the more the merrier is always good.
It's that bandwagon curse.
But you can see here pretty strong consistency in sales, just a little bit of volatility you can see in 2019 and 2020. Littelfuse is an industrial, although they're now rated as a technology company because more and more things get technological in our world. They basically sell circuit breakers. You can guess perhaps from the name, their roots are in fuses, electric fuses, and they, over the years since being founded in 1927, that's the business that they do, is circuit breakers that have gotten more and more complex and into more and more complex devices, as we'll see as we review the company. Notice value line at yesterday's price had pretty optimistic potential returns, 17 to 29 over the next 3 to 5 years, and 25%, which is pretty decent in the shorter term, next 18 months. Next slide. Here's how I found it. I just decided let's take a look at the roundtable portfolio and see what is attracted there. I ranked by par, and lo and behold, the highest sweet spot company, although some of those yellow companies that are just above the sweet spot are high quality and certainly deserve some attention, I said, let's just jump in with Littelfuse. You see MKSI, MKS Instruments there, but again, I could just hear echoes of people screaming new Cognizant if I had picked that. So I said, let's do Littelfuse, which is a much smaller proportion of the portfolio. Next slide. Quick industry study in comparison. This slide ranks by par. You see it's the second highest ranked company in the industry and has excellent quality overall and financial strength compared to LSI Industries, which is the higher, the only company with a higher par. Next slide. Ranking by quality, again, it's right among the top 3. I like looking for best among the best in quality. And again, you could see among these excellent quality companies, Littelfuse is the best buying opportunity at the time based on par. Next slide. Again, a little bit more detailed description of the company that I mentioned. They sell fuses, fuse blocks, diodes, LED protectors, various relays, which again is power management, battery management, switches, and what they're really starting to get more into and looking at a potential high growth area for the company going forward is that vehicle power distribution, both individual EVs, electric vehicles, as well as the battery infrastructure. Well, batteries in the vehicles and then the infrastructure to support recharging. And notice that foreign sales are a significant share. In fact, well over 50% in 2021. Next slide. Some slides from the company's investor presentation, just giving you a little bit of who we are, what we do, and how they plan to grow. The company, even though it has been around since 1927, does grow through acquisitions as well as seeking to cross-sell and grow internally. I think there's a slide here, but if you do the math on what the company's projecting for its future growth in the low to mid double digits, it's predicting about half of that to be organic growth, which is internal, and about half through acquisitions. Next slide. They like to focus on their sustainability aspect, and they do mention here, as is getting to be a bit trendy in some respects for companies, talking about ESG, the environmental, social, and governance issues, but here is their ESG outlook for the company, which I think is something that merits taking a look at. Next slide. And as I mentioned, here are their end markets. You can see about a third is in the transportation area, which is getting into the EV charging infrastructure, as well as more traditional longer term things such as rail, marine, but it's just about all sorts of transportation that you can think of they deal with. They also are in the industrial area. again, from your heating and cooling of HVAC to factory running to motors and to renewable industries. And then really the probably the piece that gets them more in the technology side, which is the electronics, to include data centers and communication infrastructure. That touches just about all aspects of our lives, and they are providing circuit breakers and switches in that industry. So it may be a little fuse, but it touches all of our lives. Next slide. Just a bit of detail on where it fits into traditional passenger vehicles that again has then grown into the electronic vehicle and the battery charging infrastructure that they have grown into. That's kind of the model of strategic acquisitions that they do and how they seek to grow and build on their existing markets and expertise. Next slide. That's just completes what I was saying, talking about the e-mobility of EVs. And I guess I do not yet own Littelfuse. I probably need to correct that. So that's the first disclaimer. But I guess maybe the next disclaimer is I don't own a full EV, but I do own a plug-in hybrid EV. So maybe I'm biased a little bit in that area. Next slide. Here is the company's outlook for the next year. And yes, they do break out the growth in this slide. As I had mentioned earlier, you can see they're projecting between 10 and 14% growth totally in revenue over the next 5 years, roughly. This was actually started, goes back to 21, so it's actually last year into this year and then out to 2025. And really, they boil it down nicely at the very bottom there. Robust organic growth enhanced with strategic M&A, mergers and acquisitions. They're shooting for a high return on invested capital, strong cash flow, and then returning the cash flow, a good chunk of it to shareholders, which would be through dividends or share buybacks. Next slide. And these are their primary growth areas. I think I've pretty much touched on those at the top as far as e-mobility and energy areas. They are seeking to expand geographically. There you can see in the east, both what we would call the Far East and kind of Central Asia as well, with India. And again, as they have done pretty much since the start of the company, build on their current expertise and leveraging what they do well now. Next slide. And here are my judgments. I chose a 12% projected growth rate, which is right in the middle of the company's projected areas, right in line with the Value Line and other analysts as well. I've been relatively conservative on the margin. If you remember the first chart that showed consistent sales growth, a little bit of volatility in earnings and pre-tax margins, because the company, although it's a tech company, it is serving industrial markets, so it has a bit of industrial cyclicality to it. And I've chosen to just stay with the average profit margin for the last 5 years being reasonable over the next 5 years, although right now the current profit margin is more like 16 or 17%. So I could be pleasantly surprised. And that all works down to $17.30 in EPS. Next slide. And then using a high PE of 35, I think that's an error. I believe I lowered my high PE to 30. So I must have spaced out in doing that. I believe that's actually a high PE of 30, not 35. It was 35 last time I did it. Gives a potential return of 17.5%, using the average PE of 20, a potential return of 12.2%, and again, manifest par of, again, I don't know where that number came from. That I think I mixed my slides up perhaps here, because manifest par is actually 22.5.
I'll clean you up in a few minutes.
Yep. So that's why I knew you were going to save me, Mark. So
Okay.
I appreciate that. But yes, actually, that manifest par yesterday was 22.5. So which again just shows that there is significant potential upside if the company beats my expectations.
Okay.
So I'm adding another 1,000 in Littelfuse.
Oh, we had another slide. There you go.
That's what it. When I do these based on a previous one, I leave the old one in until I get the new one. So I make sure, and I forgot to delete the old one. There you go. These are the right numbers. 21.4%, 14.4, and then that compares to the 22.5 with manifest.
Okay.
So you saved me even earlier than we thought, Mark.
And I didn't even know I was doing it. Ken, I can't figure out why this slide keeps creeping back in here. But Portillo's continues to be the best selection from about 3 months ago. And everybody get out there and support us at Portillo's as shareholders.
Shameless, Mark. You're just shameless.
All right. I'm going to double down on size selection of Littelfuse, and I'm going to do it in honor of Ichabod Crane and the Headless Horseman, in honor of this time of year. And it's actually a tribute that connects up with the Workhorse presentation that Ken and I did a few months ago, where we pointed out that the medium-sized companies are extremely important to our portfolios. So that's my linkage. Here's a list that we presented earlier today of some of the finalists in our hunt for the best small companies for 2023. And again, we're going to be selecting these in final form a week from tonight at a special edition of Roundtable and Bull Sessions. And you can see that there's some fairly well-known names up at the top. I would encourage study of any of these companies. But what I'm pointing out here with the horse is Littelfuse is a little bit big. It's a $2 billion company, as Cy has told us, and but it ranks very high on this list in terms of, for all the attributes that Cy just covered. We're looking at a return north of 20%, a growth rate greater than 12, just awesome quality when it comes down to all things balance sheet and financial about the company. It has a projected return on value that's basically projected cash flow divided by enterprise value, and that checks out and correlates pretty nicely with the projected annual return. You can see Value Line has a 15% forecast. Morningstar thinks that it's 33% on sale. The analyst consensus is checking in at 40%. And as I mentioned just a few minutes ago, a fairly decent near-term outlook also. So it's kind of hard to look the other way on this one. But it's not. It might not make the small company list unless I can really subdue Ken and get him to relax a little bit and allow a workhorse into the small company portfolio. So I'll be working on that for the next few days for sure. So again, I like the company a lot. Here is a lot of what Cy talked about. In general, you're looking at a company with a strong, a little bit of industrial cyclicality in the sales, but very hard to ignore the fact that the trend line through all of those points, which is operating at basically at a 10% level, basically hits them all. So even with a little bit of cyclicality, you are looking at a 10 to 12% growth rate for this $2.3 billion company. So again, basically a $4 billion company a few years out. I went a little bit higher on the projected net margin. When I say I am actually speaking of the analyst consensus following the company. A PE ratio in that average of about 21. That lines up pretty well with what Cy was saying. Pretty easy to sell when you look at just a little bit of a downdraft, a little bit of economic disruption. but anywhere in this 20-ish range seems to be something you can make a case for. The profitability of the company over time, Si's already covered this. It's spectacular. I mean, for a company that has bottom line fluctuations here, they're fairly minimized and fairly steady. Their cash or operating margin also very steady. You can almost set your watch to it. So that basically sets you up with a pretty good up straight and parallel situation, both the sales and the earnings down here. You can see the price disruption with COVID and some of the supply side stuff that Si has mentioned in the past. The point that I like here is looking at a very long-term picture of the return forecast. It's rarely been higher. I mean, if this 10 years basically looking back looks pretty good, and the quality has been steadily improving over the last several years. So just some other major highlights. Again, extremely good characteristics, top tier quality. The fact that this projected return on value is a pretty good audit and double check on the projected annual return. Those two are virtually the same. So we like it. Probably a buy below 254. It's currently at 214. So we're in basically in this buy zone that's driven by our return expectations. And here you go. Actually, a fairly minimal amount of interest. Their long-term debt, they have that much in the bank in their checkbook. So the long-term debt really isn't a consideration. But might come in there if they do some of that organic growth type stuff. Banks are willing to lend them money at 4.5. They have a lot of faith in this company. So the company's trading down at 18% of the range between its 52-week low and 52-week high, just basically as attractive at less than 20%. Again, Value Line checking in with a pretty positive number here. Here's the other numbers that we mentioned. The analysts think it's on sale, so does Morningstar. And I think it's time to basically jump on that Si Lynch bandwagon and ride it with Littelfuse also. So with that, we'll switch to Ken's latest love affair bank.
Well, I've had a lot of respect for this bank for a long time, Mark. This is Western Alliance Bank. WAL is the ticker. Next slide, if you would. And I'll start with the visual analysis. It's just about as pretty as you can make it. Our tools from Better Investing allow you to put assets right onto the graph, and assets are the lifeblood of any asset-based company, and that would include all banks, insurance companies, brokerage firms, things like that. And that aqua line is the assets growth. You'd like to see that paralleling roughly the sales growth for the bank. The traditional sales growth line is the green line, and you'd like to see both of them roughly paralleling the blue line, which is the earnings per share line. And if you look down at the numbers at the bottom, I've included the growth rates. You get sales growth at 21, you get asset growth at 22.7, and you get earnings growth at 25.7. That's pretty close in my book for me to say that this is up straight and parallel. The bank's been doing pretty well. Those future dots, which are on 2022, 3, and 4, are coming from the Morningstar data that is provided by Better Investing. And you'll notice that my projections are leaning on those dots quite a bit to help me set forecast numbers. I'm very comfortable with that 20% sales growth, especially since the 10-year growth rate has been 21. So sitting at a number very close to that makes me feel pretty good. I probably could raise that historical EPS number to something very close to 20. But for this exercise, I'm going to keep it what I view to be very conservative at 15, even though the 10-year average has been at about 25. The most recent gain was only 5% in earnings. So we'll see what happens as the years progress right here. All in all, it's a great visual analysis, and I would continue the study with no problem. I like to go to the company's website after I take a really hard look at the visual analysis. So let's go to the next slide, Mark. And I've chosen just a couple of representative slides from the company website. They rank very high on Forbes America's Best Banks. In fact, for 2 of the last 3 years, they've ranked as #1 bank by a number of different agencies that rank regional banks. You'll find Western Alliance Bank near the top in almost any one of the different rankings you might pull off the internet. Western Alliance is in fact a family of banks. You won't find any banks actually tagged as Western Alliance, but you will find a large number of banks with the brands that you might see coming down the side of this slide right here. They began their history, next slide, Mark. They began their history in Nevada, and they had a pretty simple and still have a fairly simple business model. You're seeing where they get most of their loans, and the loans are the way that banks make money, obviously. They make money by loaning it to people and charging them a various interest rates. You can see that a little bit more than 40% of their business comes from commercial and industrial loans. And about 30% of their business comes from residential and consumer mortgages. That leaves the rest in the middle there for construction loans. CRE stands for boy, my mind is going to go blank right now. CRE, commercial real estate, owner occupied and non-owner occupied, the various types of loans in commercial, stores, restaurants, things like that. So a very traditional bank, the money going for loans in very traditional areas. Next slide, if you would. You see a slide coming from 2010 when over 40% of their business was coming from the state of Nevada. You see the slide moved up to the third quarter 2022. You see that the business is much more diversified, and now about 37% of their business is coming from the state of California, still doing significant amount of business in Arizona and Nevada, but expanding into real estate that is outside their traditional 3-state area. In fact, about half of their business outside the traditional California, Arizona, Nevada, where those 3 states meet and where they're still doing an awful lot of business. You can see the different categories of loans that are there, and I won't bore you by going through each one of those. Next slide, please. Thank you. I use a number that comes in our data feed from Morningstar. It's return on average assets. And I've been taught by folks that are in the know that this is a very sensitive number, and it's a number that can tell you scads and scads of good information about a bank just residing in this single number. A good solid average for all banks is about 0.85% for the return on average assets. When that number can be pushed up to 1.25 or thereabouts, you're looking at a good solid bank. And when you can push that number up to 1.5, you're looking at an outstanding bank. When you can push it significantly past 105, like maybe to 1.86 as the 5-year average for this bank shows, then you're looking at one of a very few banks that manages to be ranked consistently in the superb category. This number has more meaning the longer that a bank can hold itself at these very high levels. And if you'll go back for Western Alliance, you'll notice that it's about at 1.5 starting in 2014, and it's been able to keep itself there up through 2021. A very, very high number. I would challenge you to find more than a handful of other banks that are able to maintain this kind of return on average assets over this length of time. Next slide, please.
That sounds like a good screen for a future bull session.
Okay, next slide. There we go. The market hates banks right now. They're trading at lows. If you follow banks, you might know that recently most of the money center banks reported their earnings, and finally we began to see a little bit of green shoots, a little bit of optimism about the business models of these big money center banks. We still have very little optimism when it comes to good, simple, old-fashioned banks business cycle. But think about it, folks. If they've been able to make good money with 0% interest, what might they be able to do as interest rates move to 2.5%, 3.5%, 4.5%, 5.5%, 6.5%? That's where the banks are headed, and I'd like to get in near the bottom. I'm very comfortable buying a bank with a PE value somewhere beneath 10, and I'm very comfortable at coming up with what's the potential if I give this bank a runway where the PEs are going to be a little bit challenged. So I took the 5-year average and set it as the high PE for the next 5 years. That's where the 11.6 comes from. And then I took the lowest of the low PE values and set it as the average low for the next 5 years. That's giving me a average PE of just a little bit over 7, 7.5 maybe. So I'm saying that the current PE is just fairly average for the next 5 years. I would fully anticipate PE expansion going on quite quickly as this bank became extremely profitable as it had been in the past. Next slide. And even with these very low PEs and that very conservative call on earnings per share growth at 15%, I'm expecting the par value for Western Alliance to be up around 19, 20%. I get great validation from Manifest that's calling for the par value to be at 19%, 18.9% to be exact. This is before trading happened today. This is pretty accurate just before trading happened. Buying really great quality companies, 95 quality rating, at prices that I consider are low enough to give me high par values is what makes me money in my portfolio. So I'm suggesting another $1,000 into Western Alliance Bank.
Sounds good. Thanks, Ken. And as the aforementioned discussion on Adobe, Matt, take us away.
Yeah, well, it was nice of you guys just to cover the introduction, the background on Adobe. So maybe I'll go a little faster. Go ahead, next slide. So just for reference, some of the reason why Adobe has recovered from what we'll talk about, that September performance that put it in the doghouse on the Rule of 5. They just had and I wish they didn't call it an analyst meeting. Usually call it an investors meeting, but okay, an analyst meeting just a week ago, October 18. Had if not great news, had a minimum amount of bad news to say about everything that's going on in the world, and the market has definitely shown confidence, and it's come off of its lows in the last month. So this is where a lot of my source material is, because it's the freshest material, and it would be the first place I would go if you want to catch up on the stock or get to know the company. Next slide. So just a couple slides on what Adobe is. There are two primary segments. What Adobe has been since the beginning is a software company focused on content creation, all the way from actual print media to web media to multimedia. It starts back in 1982 in the lower left corner with a language called PostScript, which allowed what was the 1980s and early 90s buzzword of WYSIWYG. What you see is what you get, the whole graphic user interface, all that ancient history now. Going up through Adobe Photoshop, which is still a cornerstone application for them, how a lot of people get introduced to the Adobe world. So just like people get introduced to the Microsoft world through Microsoft Office tools like Word and Excel, Adobe, which has its own sort of design language, a sort of way you have to get used to driving it. A lot of it comes through Photoshop, including myself, and then move on to other tools. Then going on to probably familiar, even if you don't know the name, Adobe Acrobat in the PDF document format, which is sort of their free intro to the world. In fact, they currently estimate that the number of PDF documents in existence is somewhere in the trillions. Think about how that is on a per capita basis for everyone in the world, but gives them sort of an in to just about any kind of document or content creation in the world. And then moving on, Macromedia was a competing product suite that they integrated. Omniture was a significant acquisition that has created the other leg of Adobe. I'll cover in the next slide. And then going on, the little white kind of infinity symbol is the Creative Cloud. So their migration from selling new software to annual licenses, which has really driven the company's growth in the last decade. Next slide. So we talked about the Creative Cloud. Here is the Experience Cloud, and this is, like I said, came from that one key acquisition. In fact, we talked about Microsoft's performance today. Google is also sad today, down about 6% after hours, because in its almost $60 billion of revenue in the quarter for Google, YouTube missed their revenue by 400 million. And so there's a lot of companies that are driven by online advertising, which have had a sad year, if not a sad quarter. Adobe is involved in online advertising, but not to sort of provide it or sell it to you, but to help you manage it. And so the first product on the left was talking about insight and data, so going across platforms. How do we compare platform X to platform Y, and are we getting our bang for our buck? But they've grown, going to the right more into helping you actually execute on that. So why would we have a decision about do we advertise on Meta or Google, and which one are those platforms telling us we're getting our value for, versus shouldn't we be managing the whole experience, right? Not many users only have one tool. Do we know that we're working together on that, and do all the tools sort of have a role in effective advertising and getting consumers to buy things, even if that isn't the point where they click? So that's become a very sophisticated suite. It's not quite 20% of revenue, but it's the fastest growing segment right now. And it's all sort of behind the scenes, but it integrates very well with the fact that, again, their primary and first focus was creation of content. So this is sort of management of content. So we'll go to the next slide and talk about what's been the adventure last month. So the trouble started with the announcement of the acquisition of Figma, which is a very small company. Figma had $200 million in revenue in 2021, and Adobe announced a purchase for $20 billion. That's the kind of thing, only in tech can you find that sort of thing. And I have the articles on the right. Certainly, the initial reaction was, huh? was sort of, in what world does that make sense? Now, Adobe, so Figma has two primary applications. It is an online collaborative design tool. One is sort of a whiteboard space, so sort of an open sandbox you probably have used in tools like GoToMeeting. sort of whiteboard space. The other one is a much more sophisticated product design tool. But what Adobe also found was that there is a significant amount of customer overlap, even though Figma is much smaller, and they do give away their entry-level tools. A lot of Adobe customers were using those. And so then you get to the second article that talks about that in this acquisition of this very tiny company, that they're looking to actually control the entire creative market, that somehow it was a monopolist move. And I'll say I had a wise person that I knew that was involved in labor relations, and they told me, when you make a good decision in a difficult circumstance, the way you know that is not that everyone's at peace with your decision, but that you're getting equal amount of complaining from both sides. So either this was a colossally stupid move where we're just burning billions of dollars either to snuff out a potential competitor who has entry into our customers, or maybe just something that might flame out on its own, or it's a very shrewd move to sort of keep a near monopoly or a very high percentage market share position in the creative world. And so that ends up in the price graph on the lower left shows, and I gave a 6-month view so you could see through the summer it kind of Adobe has kind of drifted with the rest of the tech market. You know, down in June, kind of up in late July and August, then down again. Then there's that cliff where you can tell the cliff by looking at the high volume, which is early September. But then come back up, and again, in that sense, people are just saying, why in the world would you pay $20 billion to this company? But then as more opinions have come out, and certainly again the analysts swung back up from that, but still significantly below 6-month averages. Next slide. So again, Figma's 2 tools. You can see a picture here, right? A more simplistic sort of everyone's tool for whiteboarding or just open creation, called FigJam. And then Figma, its namesake tool on the right, much more robust full product design software. Next slide. So, you know, what does Adobe get to here? You see it doesn't really talk about the future of either of those 2 tools, right? It talks about overall goals of product design, of collaborating on the web, of creativity. You know, I can only guess. Adobe has been fairly coy about what they're using for. I can only guess that one is to get the people behind it if they have a compatible culture and goals, but really I would probably think that there is some back-end intellectual property that Figma has that Adobe found either superior to their own or complementary to what they have, and that's what's really providing the value. But that's just my guess. Next slide. So this is kind of the meat. I talked about that the news wasn't so bad coming in this analyst call. And you can see for 2022, they have affirmed their targets. Really, it's just the 4th quarter left to go. But on the bottom, you can see the headwinds that they're claiming, including FX. The company does a significant amount of business outside the U.S., not in dollars, not denominated in U.S. dollars. So they are impacted in FX. Like so many companies exiting Russia this year, and a tax increase on top of it. But otherwise, reaffirming what they said today. And then next slide. Then for next year, this is slightly below their prior guidance. Their prior guidance for 2023 in total revenue was 19.85 billion. Oh, I'm sorry. This is the percentage basis, but anyway. And their revised guidance is 19.1 to 19.3, so that ends up with a 9% year-over-year growth for the overall company. You can see from the second line how important the digital media segment is, the dominant segment that matches 9%. So even though digital experience, the third line, is growing 13%, hasn't really moved the total company needle yet, but it will. As it keeps growing faster than the overall company. But then also looking at the column on the right, and constant currency, you know, can be a funny thing. What should the dollar exchange be? Is maybe second only to politics, to what you might say. But for comparison of year over year, at least, that's almost a 30% growth drag overall with the strong dollar going on. So again, as things normalize, if that's what they need to do from where they are now, from dollar parity with the euro, or even more than €1, then that would just factor into increasing Adobe's growth. And then finally, on the bottom, GAAP earnings per share in line with revenue growth. So we always want to look at up, straight, and parallel. Okay, next slide. So our trusted advisors value line. Now this value line is from early August, right? So it's before that fall. Fortunately, it should be updated in a couple weeks. So that was from a price of $391, and it's $323 today. Still had a low expected return of 16%, a high of 22%. Again, looking in the lower left, then the annual rates of growth, revenue 17.5 and earnings 14.5. More robust than the guidance given for next year, but in line with the constant currency numbers that the company gave. Next page. Our other advisors, Morningstar, and this is kind of interesting. So Morningstar has a 4-star rating on here. Its 5-star price is $255. The low in this blip after the news was in the 270s. So never actually reached 5 stars. So you can think about what that means in terms of what the price might really go down to, but still plenty of room between and this last close is from Friday. So again, we're about 323 now with a 425 fair value. And we'd seen it before, but for Manifest, 19.9% par, pretty nice, in the sweet spot, high quality, of course, and sales growth again, kind of in line that mid-teens that we've seen in the other references. Next slide. So looking at the SSG, again, we can see and I've left it in here, but I would recommend when you're doing your own SSGs, you can take them out if you're gonna look at historical growth. That period on the left of the chart from 2012 to 2015 was a changeover from selling software or perpetual licensing software to annual licensing software. Lest you think I'm a genius, I actually have owned Oracle before, or owned Adobe before, and actually left somewhere in the 2013 range because I was skeptical of that growth. So that was a poor decision on my part. I did fine with my alternatives, but I've always been looking for a place to get in on Adobe since then. As you can see from the bar charts here, now back to 2022, we are near the 52-week low. We just set it in the last month. So that's a good opportunity. In fact, not just a 52-week low, below all of last year's price as well. So going back to 2020 to find a price in that range. I have turned on the analyst estimates. I've put in the value line estimated item in the 2026 line, so you can see how my numbers line up with theirs. For historical sales, I chose a nice round 15%. EPS is growing a little bit slower than sales. I won't go into it, but I'll say one of the factors in my preferred procedure, while Adobe does have a robust share buyback plan, like many tech companies, in lieu of a dividend, they are paying cash plus shares. They don't have 20 billion in cash. They have a significant amount of cash. For Figma. So I have modeled here that they are going to maintain their share count, not reduce it in the next 5 years. So in effect, they would recover from the dilution from Figma in 5 years in this point. I think that's pretty conservative. The company has not given specific targets, but has certainly said that they're going to focus on that with extra cash they have. But that's the first of my conservative judgments. Section 2, all green, excellent pre-tax profit and return on equity, and looking at debt to capital, they've not done that by having high leverage. They do have some debt. Again, they have a significant stock buyback plan, and they have made significant acquisitions before this. They have some debt, manageable debt, and excellent profitability to take care of that. Next page. On the back side, and I apologize, this is a little small. I probably should have split it up, but I'm trying to connect these two. So it does have a tech stock-like PE, and you have to get used to that if you're going to own this company. Just to point that out, if you're not zooming in, The average high PE, even though I've struck out 2021's prices or PE levels, and that's one point I'm usually, that's a standard point that I try to be conservative on. The highest high and highest low go out. We're still above 50 for an average high PE and almost 30, 29.6 for an average low. Just to prove a point, when I've calculated the high price range, I've actually used just 30 for the average high PE. So I'm actually using something actually almost at the low level as a high, just to say, well, so what? What if for the next 5 years the market is pessimistic about tech stocks as much as they are today? And then for the low price, I used actually the 2020 low price of 255. I'll say when I actually did purchase this 3 weeks ago, and my purchase price did begin with a 2, but it was close to 300. That 255 was a little uncomfortable for me when the price was in the 270s. So I actually had it lower in my actual SSG that we were buying. At the point where we're back above 300, I think that's perfectly comfortable. So even with sort of a ridiculous high PE, just to get us used to it, we can still come out with a fairly decent buy rating on this. In addition to the other points where I've been pretty conservative on it. For a company that is a solid owner of its particular market niche with creative professionals, and which has shown and grown its last major acquisition into an entire different division of the company, which now commands about 20% of revenue. Now, just so you come back on me, this is as we always say, it's for demonstration purposes, right? I'm proving a point that even without PE expansion, because today's PE is 31, this can be an excellent buy for a company that's growing very consistently. But don't come back to me in 5 years and say you sold at a PE of 30 or when it went over 30 and went out. Like I said, the Morningstar 5-star buy price was 255, which happens to have been the 2020 low, what I've put here. Their 1-star price of the strong sell is actually 650, a full $100 above this. So excellent potential for a company that has a long history of being the type of company that we want to look at as better investing investors.
Okay, that's all you got, right, Matt?
Yep.
All right, thank you very much. I'm sure Ann Manning is smiling. That's one of her favorite companies to track also. All right, Kim is not here, so I'll just just throw it out there. She basically thinks that we have a situation with VMware, ticker VMW, where the shareholders and both companies' boards have locked in the ability of anybody who owns that company now to basically sell their shares for cash at $142.50. You can see that the current day price is $111. So her theory is that they won't run into any regulatory issues, and that they expect to close in the next fiscal year, which begins November 1st. And the fallback position is that 0.252 shares of Broadcom if it takes off. But basically, I'm mystified by what's going on here. That's quite a differential between what you can sell a share for. Wall Street doesn't leave $31 on the table very often. Here's a look at what's been going on with Broadcom. It's been coming down with the companies in the semiconductor industry. But again, the narratives for both of the companies say something could still happen that's negative, but it's actually an interesting opportunity. This 142 is not fiction. It's locked in and should close fairly soon. So she thinks that it's an opportunity, a very unusual opportunity, to buy a share of VMware and basically flip it. Really.
That's the classic Warren Buffett buying dollar bills for 75 cents.
Yeah, and I think that Wall Street's probably caught up in all the bad news and the speculation about these deals not closing, and just it's hard to see. While Broadcom itself, not the most attractive company by our standards, but nothing to really look that badly either. At 460, you're still looking at returns in the 12 to 18% range. So it's got a bit of a floor on it, or a form of support. And for a company in this industry, it looks pretty good to me.
Mark, to respond to our audience, is there anybody on the panel that has a specific reason for that $25, $30 spread between where it's trading and what it's been offered at?
I do not, even though I have followed VMware, I have not followed this particular offer closely, and so I can't say except speculate. And Mark kind of hypothesized, but the market is clearly saying we do not expect the deal to go through.
Yeah,
I mean, that's the explanation. Now, why they're saying that, I don't know.
Yeah, I'm just going to say that I would urge anybody that's considering putting real money into Broadcom right now that they come up with a better reason than we have for the great difference between what's being offered for the company and what the company is trading at. The only other thing I can think is that they're expecting Broadcom stock to maybe reduce itself in price. And maybe they're offing it off the $116 of Broadcom stock. The quarter share is worth in Broadcom, and maybe is what's pushing the price down. It's terrible to try to figure it out, though. I don't have any real thing going on.
It's a tough call because the 142 is firm. I mean, we've watched what's going on with Twitter and how that thing has kind of flipped around. The other thing that she believes is that the rhinos are basically underestimating Broadcom's heritage of very successful M&A activity. So there's some arguments to be made.
Okay, I have a hand in the air, Mark, and I'm gonna, before we go to the poll, I'm gonna recognize Lawrence Serres. Lawrence, I'm trying to unmute you, but you're muted on your end. You have your hand up. Did you want to say something? You'll have to unmute yourself if you want to speak. And that was an inadvertent hand. So let me go to the polls then right now and launch. Oops. Get the right one here and launch it. And we're asking you to cast a ballot as to which of these four you might want to add a second position to. And if you don't like any of them, then of course you have the choice of none of the above as well. We'd love to get 85, 90% of you voting. We have a nice size audience out there, and we have 76%, 80% of you voting. Let's get another dozen or so with hitting that key right there. Doesn't cost anything. It's all free. And I'm kind of counting to 10 right now, and I'm going to close the poll.
This is
and
voter
I'm
turnout.
going to
Kevin's trying to split our vote, Mark. He says Littelfuse should be there twice.
Littelfuse Cy, Littelfuse Mark, right? Okay. And we're going to add an extra position in Littelfuse. You can see that it got just over half the votes, 51%. Western Alliance about a third of the vote, and Adobe about 12%. So we will put an extra $1,000 into Littelfuse. And Mark, I'll send it back to you.
Sounds good. Shazam, I'm on a winning streak and size coattails. Cool. Okay, so let's go ahead and just a reminder that we do archive all of these presentations on YouTube, on the Manifest Investing channel. You can search for roundtables. You can see that previous editions of the roundtable are shown right there. If you'd like to be notified anytime we add a bull session or a roundtable, you can simply subscribe, and we'd be happy to notify you when that actually happens. And Cy would like to point out that he's there as wisdom in the superhero. All right, for coming attractions, this is something we have to bolster up because we do have some chapters that have reached out to us, and some local gatherings that we do need to add. But we will do the best small companies for 2023 a week from tonight at 8:30 Eastern Time. It'll be kind of a joint round table bull session, best small companies, where we'll go and make our final selections for the next year. We were riding a 7-year winning streak of beating the market. That appears to be possibly suffering from the clock running out on us this time around. So we'll try to get back on the horse and keep going forward. We do have a 16% rate of return over the last 8 years, even with the nasty year involved, beating the market by about 6 percentage points.
Yeah, let me tell the audience, Mark, that if you are getting a reminder from our reminder list once a month for the regular roundtable, you will receive a reminder about this special program, and it'll have a link for registration right in it. If you're not getting that reminder, then we'll also have the ability to get a registration link from the Manifest site under events, or from the Mid-Michigan chapter part of the Better Investing webpage. That's betterinvesting.org. And the Mid-Michigan chapter will have a link to that special session. Worst case scenario, drop me an email if you can't find a link, and I'll shoot something off to you that gives you a link so that you can come to the first session, the first special roundtable, and we're going to talk about our best small companies. Mark, what else do we have coming up here?
Yeah, that link at the bottom is a public link, and it will be there in the morning. We're going to get together for breakfast on November 12th in the Saginaw area and celebrate some stock picking. I think they've had a rough year too, but they have some really phenomenal stock pickers, and we'll hear from them, and we're going to just basically chat a little bit about the market. Our roundtable will be just after Thanksgiving in November, the November roundtable on November 29th, and Ken and I will be doing a presentation at the American Association in Troy, but it has been postponed for now. The final throes of COVID, we hope, with program cancellations and shuffling on the part of that other organization. So with that, do you have anything else, Ken?
I don't, Mark, except I want to wish everybody a wonderful Halloween and a great Thanksgiving. We won't come back to you on an official roundtable until the 29th, and that's after Thanksgiving. But again, we'd love to see as many of you as can possibly turn out next week when we unveil our list of the best small companies for 2023. Thanks to Cy, thanks to Matt. Matt, especially with the short notice that I gave you, you did a wonderful presentation. And as always, Mark, thanks to you for all you do for this program. This couldn't go on week after week after week without you helping an awful lot.
Oh, it's a pleasure. You're welcome. So with that, I think we can go ahead and sign off and see everybody next Tuesday or after Thanksgiving. Happy Halloween, everybody. Better investing.
Good night, all.
Good night, everybody. Thanks.
Good night.